As you all know, world leaders of the G20 gathered this weekend in Washington to discuss solutions to the global financial crisis. And although the crisis originated in the deregulated financial markets of the developed countries, the impacts of the crisis, both in the financial sector and in the real economy, are spreading globally, including to many countries of the global south. Today we brought together two independent leaders, Martin Khor and Mark Weisbrot, to discuss questions related to the impacts of the U.S. financial crisis on developing countries, including such questions as, will the solutions discussed this weekend at the G20 meeting help or hurt developing countries? And what can be done to prevent the International Monetary Fund from prescribing inappropriate policies for countries that borrow during the crisis and from monopolizing emergency lending to developing countries? As well, we'll discuss what are some practical alternatives that could resolve the credit crunch. Panelists will also discuss steps governments can take to reduce the impacts of the U.S. recession on the real economy in developing countries. So I'll go ahead and introduce our panelists. As many of you know, economist Mark Weisbrot is the co-director of the Center for Economic and Policy Research. He has written numerous research papers on economic policy, including a column that's distributed to over 550 newspapers through the McClatchy Wire. He appears regularly on national television and radio programs and in most U.S. newspapers, major newspapers. He is co-author with Dean Baker of Social Security, The Phony Crisis, and is also president of the group Just Foreign Policy. Afterwards, we'll be hearing from Martin Khor, who is the director of the Third World Network, a leading NGO of the South, an economist, journalist, and former university lecturer in Malaysia. He is also an advisor and consultant to a number of United Nations agencies and other important international bodies. He's written extensively on matters relating to trade, development, North-South relations, the international financial architecture, the environment and ecology, and intellectual property rights. Among his most recent publications are Globalization in the South, Some Critical Issues, and the WTO, the Post-Doha Agenda and the Future of the Trade System. I know for many of you as well, Martin is a big personal hero of mine, and we work closely together on WTO issues, and I'm very, very honored that he's able to share some of his time with us today. And obviously you can find a wealth of his writings at the TWN website, twinside.org.sg, and we have some of them outside on the table as well. If some of you haven't seen that website, it's a wealth of resources. So we're going to hear some discussion and introductory remarks from Mr. Weisbrot, and then we'll give the floor to Martin. Go ahead, Mark.
Thanks, Deborah, and thanks everybody for coming. And I want to also thank Mark for being here. His website is one of the Third World Network website is one of the, I think, one of the most important that you can find on a variety of issues, but especially trade and WTO. And I've used their information for years. I really appreciate being here. So I just have a few points to make that I think are not getting the attention that they should get in the media. Obviously, here in the United States, we have an economic meltdown, and that's going to be subject number one. And we're only beginning in terms of the recession here, and there's going to be a lot of work to do around that. But there's also, in the sense that the G20 meeting was covered, and these other issues that have to do with the rest of the world economy and the developing world in particular, there's something very important, I think, that's been missing from the debate. And so I want to look at that. Most importantly, what you have here are two phenomena going on behind the scenes. One is that you have this huge crisis, financial crisis, that the epicenter is really the United States and to a lesser extent, but also Europe and Japan, the other rich countries. And it is spreading to developing countries. Now, this is somewhat exaggerated. You hear a lot of people say, when the United States sneezes, the rest of the world gets pneumonia. That's not exactly true. It is possible for other areas of the world to, even though they will be affected, but to avoid recession or to avoid very serious slowdowns in economic growth. A good example is China. They have slowed already from 11% annual growth to 9%. And they may slow a little bit further, but they may not. They just announced last week a $587 billion stimulus package. And that's about, over the next 2 years, that's about 7% of GDP. So it's, you know, 6 times the size, 5 times the size of what we've had so far, and a lot larger than anything that's being considered by the Congress here in the United States. And so they did this 10 years ago in the Asian crisis as well. And if you look at China's economic growth, it grew right through that crisis, 8 to 9% annually, while the rest of the region, Indonesia, South Korea, Thailand, Philippines, other countries, took very large losses in output and employment. And poverty rose enormously in these countries, and some didn't recover for years, like Indonesia, for example, which was the hardest hit. And so it really does make a difference. And so countries other than the United States and Europe and the rich countries can, in fact, pursue expansionary fiscal and monetary policies as well. China's begun to lower interest rates also. They can pursue these policies, and they can counter the effects of the economic downturn. Now, every country is in a different position, and you know, I won't have a chance to go through a lot of countries here. But I want to give a little bit of an outline, because it's very, very important that people understand this. And this relates to my second point about underreported stories. The second most underreported story is well, actually, I didn't finish the first. Let me just finish the first story, because what is happening here is something very pernicious. That is, the epicenter of the storm is here. But ironically, because the United States and Europe are able to, and have been able to, guarantee large parts of their banking system, you know, like here we're, for example, guaranteeing money market mutual funds, which were never part of the federal deposit insurance system, and now they've been guaranteed because of the crisis. So because of that, a lot of money has left developing countries. This is even more true in, say, the countries close to Europe. And that's why you see these bailout packages for Hungary and Ukraine, for example. Big ones, $25 billion for Hungary. Money fleeing these countries, developing middle-income countries especially, and going to the United States and Europe. Ironically, even though this is the place where the mess started, and these are the economies that really are, you know, the United States, well, they're all in recession or about to be in recession. But the money's coming here because it's guaranteed. We're effectively providing, we in Europe are providing a subsidy for money that comes here. Our governments are. So that causes a problem in the developing countries, and then the United States and Europeans step in and say, well, and of course they use the IMF, and they've been using the Fed. The Fed extended a swap line of $30 billion to Mexico, South Korea, Singapore, and Brazil, $30 billion each. Okay, so what they're saying is, well, if we like what you've done recently, or we like what you're going to do for our purposes, our political and economic purposes, then we'll give you some credit, some foreign exchange, and the others are, you know, they're going to be in trouble because of the mess that we created, and because we're able to attract capital from your country. So that's a big story that isn't really being reported, and it's something that has to be countered. Now, the second big story is the comeback of the International Monetary Fund. And I won't, I've written a lot about this, and you can find it on our website. But so I won't go into the whole story. But basically, you know, the IMF used to be the most powerful financial institution in the world 10 years ago, and that was not so much because of the money that itself that they loaned themselves, which has never been all that much, but because they were assigned through an informal arrangement a kind of a gatekeeper role, or a creditor's cartel, where if you didn't, a government that didn't satisfy their conditions didn't get money from the World Bank or the G7 governments, or like you see in these bailout packages for Hungary, Ukraine, Iceland, where you have a lot of money coming from the European Union, for example, and it's all dependent on IMF approval. Now, this relationship broke down over the last decade, and I want to emphasize this because we talked about the financial crisis the last time I was here, and I didn't emphasize that this was what happened over the last decade with the IMF's creditors cartel falling apart, literally, in the middle-income countries, was really the biggest change in the international financial system for 35 years. It was huge. Again, the media didn't pick up on it that much because, well, it's hard to say exactly. I mean, it's not like they don't understand how powerful this is to have this kind of influence, to be able to tell the country, you're not going to get any credit unless you do X, Y, and Z. And the X, Y, and Z were very many of the neoliberal reforms that we've seen over the last 30 years or so. So this collapsed for various reasons, not least of which was the IMF's terrible failures during the Asian crisis 10 years ago, where they exacerbated the crisis. Well, they helped cause the crisis in the first place by liberalizing capital flows. And by the way, when I say the IMF, I should be fair. It's not really the IMF mostly, although their economists do make a lot of decisions, and bad decisions. But it really is ultimately the U.S. Treasury Department is responsible for the IMF. So they don't necessarily micromanage it in the various countries, but they do ultimately have authority. That is, it's 185 member countries, but because of both tradition and voting structure, the United States Treasury Department has the ultimate say over IMF decision-making. Europe and Japan may have the votes to outvote them, but they really haven't done so in the last 64 years. And so this is, it still remains that way. So you can see what is going on right now. It's exactly like what happened in the Asian crisis in many ways. First, as I was saying, that the IMF helped cause the crisis with Treasury by encouraging and some pressuring these governments to deregulate their international financial flows. But then they made it worse through what economists call pro-cyclical economic policies, raising interest rates, for example, which was devastating. And then, as you know, since then, countries have been very reluctant to go to the IMF, and they don't go if they can possibly avoid it. And as a result, the IMF's portfolio shrank to almost nothing in the last decade. Got to the point where they were having a financial crisis of their own and had to lay off 500 economists in the last couple of years. So, but now they're suddenly back with $250 billion to lend, and now what the United States Treasury Department is doing is the same thing they did in Asia 10 years ago. They're saying, okay, all money that goes to any rescue plan has to, for any middle-income countries, has to go through the IMF. And this, of course, can be devastating because the IMF is not really reformed. So, first of all, it's devastating in the sense that the U.S. then gets to pick who gets aid and who doesn't. And that's bad enough right there, because that's going to be done on the basis of political criteria and criteria that have to do with certain economic interests in the United States. I mean, we're represented by Goldman Sachs at the IMF, essentially, and that's Paulson I was referring to. So that's bad, but also because of the policies that they're imposing. So Ukraine has already had to raise interest rates 200 basis points just to get the IMF to talk to them. Hungary, Iceland, Pakistan. Actually, Pakistan was one that already raised the interest rates. Ukraine is going to have to raise interest rates and balance their budget in 2009, even though their deficit is only about 1.7% of GDP, their budget deficit. So they're imposing these kind of contractionary conditions. They have this double standard that they've had all along. For the rich countries, they're saying, which they don't control or order around, they're saying, let's have a big fiscal stimulus. They're just as Keynesian as everyone else. They're with the the 400 economists that CEPR has gotten to sign the statement calling for a $300 to $400 billion stimulus in the U.S. The IMF would sign on to that if they were allowed to. And they've been encouraging the European Central Bank to lower interest rates for years. But for the middle-income countries, they have a different set of policies. Now, you can tell me when there's a 5-minute or 3-minute limit. But I wanted to explain that a little bit because you have to understand, if you can, some of the economics here, because there is a certain amount of truth to what they're saying, okay? It is true that developing countries are not in the same position that the United States and the European countries, European Union and Japan are, because, in the U.S. especially, because the dollar is the key currency of the world. But the euro and the yen are still hard currencies. So that gives these countries a certain flexibility. In our case, it allows us to run 20 years of balance of payments and deficits and just allow the dollars to pile up in the rest of the world. But in Europe and Japan, it gives them a flexibility that a developing country doesn't have. For developing countries, for most other countries in the world, if they run into a balance of payments constraint, so if they run current account deficits and they start eating into reserves, they're not going to be able to do that for very long. And so that is the rationale. That is, if you ask the IMF, well, why can't these countries do what the rich countries do? Well, that would be their rationale. Now, the problem with that argument is it only goes so far. For example, if you have enough reserves as a developing country, like China has $2 trillion in reserves, you can, in fact, you are in the same position as the rich countries in the sense that you're not going to run out if your economy continues to grow and you even run a small, or even in China's case, they could run a large current account deficit, which they're not. Then you can continue to grow and stimulate your economy just as the rich countries are doing right now. And so that's very important because most of the reserves in the world, there's $5.5 trillion of reserves in the central banks of the world. And most of it is in the middle-income countries. The oil producers, China, South America has quite a bit even. So the problem is that, so you see how wrong it is and how damaging it is for the Treasury to say everything's got to go through the IMF. The developing countries themselves can set up their own stabilization funds and provide the aid and not go through the IMF. Now, what's the state of play? Well, Gordon Brown went out to Abu Dhabi a couple weeks ago looking for money. They've got over estimated $800 billion in reserves for just a few million people, and asking for money for the IMF. They've gone to Saudi Arabia, they've gone to China, and they're trying to get money for the IMF. So far, nobody's given the IMF money except Japan. And Japan is generally does whatever the United States wants in these matters. So that's a good sign, and it's also a good sign that finally on Friday, China, Pakistan had gone to China before they went to the IMF, China gave Pakistan, agreed to give Pakistan $500 million. So there's some signs, but I think what's most important is that there has to be more. There has to be competition for the IMF. They'll do a much better job if there's competition from other countries, from stabilization funds that do not impose the kinds of destructive conditions that they often impose. And finally, I just want to make one more point about conditions. One of the things that countries are going to have to use probably in this crisis is capital controls, that is, controls on the movement of capital outside the country. And of course, it's much easier to implement these controls when the capital is coming in. But you can also control it some when it tries to go out. So, Russia is a good example. They spent $112 billion in the last few months of their reserves defending their currency against speculative attacks primarily. So this is not so impossible. It was a vital part of the Bretton Woods system, which was in place from 1944 to 1973. It's going to be a topic of discussion for this new financial architecture. So it's very important. So I just want to conclude by saying that, we have a new president. We have to remember that. He gets to appoint a new executive director for the IMF. That is the U.S. representative at the IMF. And I hope that he will appoint someone who, first of all, does not, abandons this project of trying to reestablish the IMF's creditors cartel, through this crisis, and one that also pledges to cooperate with countries that are trying to implement capital controls, that is, countries that try to keep money within their own countries, because cooperation can be a very important part of any kind of financial stability that we might get in the global financial system. Thank you.
Thank you, Mark. We can go right into your comments, Martin.
Thank you. I think I'll start from where Mark went on. And that's the old system that we had, both in terms of finance and the real economy after the Second World War, when Keynes actually put his stamp on the Bretton Woods system. And I think he understood that there was a difference between finance and the real economy. Finance is a servant, and the real economy is a master. That's the way it should be. If you leave the market system totally unregulated, both trade and finance and everything else, then finance would be the master. The tail would wag the dog, and not the dog would wag the tail. So the Bretton Woods system was instituted in which finance was put in its place, and the real economy of production and trade would be driving the car, and finance would be the fuel. That's very bad for climate change, but I mean that's the analogy at the time. And so we had actually the IMF playing its role, and its role was very boring but very important. That is to actually be part of the system of capital controls. As Mark has said, countries were not supposed to allow capital to just flow freely. They would flow if they serve the real economy of trade and investment and production. But you wouldn't have the US allowing banks and funds which just to allow capital to flow autonomously without it being linked to trade and production. IMF was part of this system of capital controls. Secondly, it regulated exchange rates, which were fixed at what was supposed to be fundamental values linked to the real economy. And if the exchange rate became misaligned, then you can change the exchange rate under heavy IMF conditions, which were imposed mainly on developed countries like the UK. And that served the economy very well until 1973. This was a period of the golden age of growth and everything else. Finance was tame and became the servant, and it collapsed in 1973. We know why. The US could not exchange gold anymore because they spent too much of their money in the Vietnam War. Very familiar. It's happening again now with Afghanistan and Iraq. But that freed the exchange rates, and therefore exchange rates became the subject of speculation. That also led to progressive liberalization of the financial system, starting with the OECD countries, and then the OECD countries trying to export that to the developing countries. Through example, through pressure of FTAs and WTO, and through the IMF wanting to change its Articles of Association in 1968 so that capital account liberalization would be part of the IMF's job. Before that, it was only current account liberalization. By current account, we meant trade and foreign investment. But with capital account, we also mean the autonomous flow of short-term capital, which was not in the mandate of the IMF and still is not, and they would have got the articles changed in Hong Kong in 1998, except that the Asian crisis prevented them from doing so, fortunately. So Asia became the sacrifice. We sacrificed our economy so that we could prevent the IMF from doing it. Somebody must have planned the whole thing to prevent the IMF. Otherwise, it would have been compulsory for countries under the IMF to liberalize their capital account. So what happened? We had the US. I think the US did a very bad thing. They decided somehow or other, or it was unplanned, to sacrifice the manufacturing sector. That has gone into a decline. Many jobs are lost. We've been talking to the unions. Manufacturing in the US has gone down. Now maybe it's due to the US allowing its tariffs to go down too fast. Maybe it's due to the free trade agreements. Maybe it's due to miscalculation or negligence. But what happened was, the fastest growing sector was not only services but financial services. I think we have all those figures. Financial services was 15% of corporate profits and it went up to 40%. So we had the ballooning and the fattening of finance and the shrinking of the real economy in manufacturing, while still trying to maintain something in agriculture through very unethical means of subsidy and so on, while forcing other countries to open up their agriculture by reducing their tariffs. So US agriculture could still maintain itself but not becoming very much bigger. Manufacturing was shrinking, and what boosted was the financial services sector. And this is why the US promoted financial liberalization around the world, because it thought that its competitive sector was finance, and if it could export its model of finance, then US financial institutions abroad could make those fat profits and take it home, where it would be the fastest growing sector, and never mind if manufacturing collapses. So today we have Citibank laying off 50,000 workers. The fat cow is becoming thinner. And maybe it will become malnutrition for some time before it gets back to its optimal weight. So you're going to have a crisis here. No manufacturing, agriculture, cheat the world and try to maintain it, and the services sector is shrinking. But the solutions that the US is having, in fact, there are many positive aspects from a Keynesian point of view. It's going back to some kind of Keynesian thing. I'm sure eventually with wisdom prevailing to some degree and with CEPR playing its role, finance will become the tail again to some degree. It will take some time, but it's moving so fast we never expected it. It will become the tail and not the dog will start wagging the tail again. That's good for the US, it's good for the EU. Nobody thought about the developing countries. So the following are 8 points in which I thought US-EU policies, which may make sense for EU and US, plus G20 statement and the policies that are coming, may have negative consequences on the developing countries and are already having. You see, you have finance and the real economy. Finance collapse. That caused many repercussions on developing countries. Real economy is collapsing in US-EU. That has even more repercussions on developing countries. So the channel through which this crisis is having an impact on developing countries is the finance channel, the investment channel, and the trade, real economy channel. These 3 channels are now coming into full play in the developing countries, and we are about to have the full force of both finance and the real economy crisis into developing countries, and we are going to suffer much more than the US is suffering because you have instruments and tools for which you can then reflate. And many developing countries don't have those instruments and tools. Secondly, you control the international financial architecture and its reform, and therefore you can use that to improve your situation. But in doing so, that same international system that is being refashioned may not be helping the developing countries, but may make the situation worse. So we will have these 2 impacts. I'm going to go very fast. Firstly, the subsidies going to US banks and European banks may make the third world financial institutions themselves less competitive because we don't have the money to subsidize. We don't have $2 trillion to pump into Citibank and JP Morgan and the refashioning of the investment banks and the insurance companies and everything else. So when one side has all the trillions of dollars to subsidize and the other side doesn't have, and our financial institutions find weakness and don't get the subsidies, they are going to suffer relatively and may be facing collapse without rescue. Yours face collapse with rescue. There's life after collapse. Many people feel that Chapter 11 is wonderful. GM should go under Chapter 11. Then they will have life after Chapter 11. We don't have Chapter 11 and we don't have life after Chapter 11. We have death. So this is the problem. The other thing is knowing that the US and EU will not let their big institutions fall and that they will guarantee investors and savers. This leads to a flight to safety, including the safety of bailouts. So we now have massive capital outflows from the developing countries in terms of investors moving out from the stock market portfolio and so on. And in future, if I were a long-term investor, I would rather seek refuge in the US and the EU because that's where the safety is, even if the profit rate in the short term is lower. Yeah? So this flight to safety factor is going to affect the developing countries a lot. Thirdly, with the US playing this great bailout role, the currency has improved in the US. I mean, the US dollar has strengthened against what people would have thought 4 or 5 months ago. That may be good or bad for the US, I don't know. Maybe it's bad for your trade competitiveness, but it's good for your being able to attract capital to fill in the deficits and so on. It's very bad for developing countries that borrowed in US dollars. Suddenly they have a debt crisis. It's a replay of the Asian debt crisis. Korea, currency fell 30-40%, a very strong country. You know what happens to India, South Africa, other countries where the currencies are falling and where there is substantive foreign debt. They lose a lot in terms of the local currency they have to put up in order to service their loans. That has become a major issue for many developing countries that have foreign debt and have low reserves. Like Pakistan has gone bankrupt. And then you have the combination of the depreciation of currency in a developing country with the fall in reserves because of the outflow of short-term capital, plus the trade surplus decreasing or the trade deficit increasing in many countries because of the effects of the real economy, and you have a balance of payments crisis, you have rapid deterioration of foreign reserves, and a long queue outside the IMF looking for bailouts. Then you have the real economy effect of through the trade channel in 2 ways. One is collapse of commodity prices. Commodity prices went up very fast due to real demand going up, for example, through China. Plus speculators going into the commodity markets because they found that they didn't get enough profit through the equity market. So they went into the commodity market, not only for oil, but for many other commodities. So with real demand falling, plus the speculators finding that there's no profit anymore in the future, leaving the commodity markets, we have a total reversal of what we had 3-4 months ago when the FAO had this big seminar. Okay, food price gone up, commodity price going up, oil price going up, developing countries not knowing what to do when they are importers. To the reverse today, which is food prices going down so fast that the food exporters and commodity exporters who are not food exporters going into a tailspin. My own country, Malaysia, our major export is palm oil, which goes into margarine, cooking oil and so on. The price had jumped to 4,500 Malaysian dollars. in March. That was a peak. Today it has fallen to 1,500 Malaysian dollars per ton. And the latest forecast is next year it will fall to below 1,000. Okay, so that's a fall of 65% to now, and another 50% to next year. And this is the major commodity for farmers in Malaysia, in Indonesia, these two countries, Thailand, and Ghana, and so on. So millions of these smallholders are now in dire straits when they had become very rich only 6 months ago. Cotton, I saw the figures today in the press that it has fallen by 40-50%. That may affect your cotton farmers in the US, but you have the new US Farm Bill and the old US Farm Bill, so the trigger will be there and then they will be saved. But for those millions of farmers in Africa that have been fighting the US and the WTO over cotton, they are in a real mess. They are in a real mess. Soya bean, again, a big story in today's internet about Brazil. How the soya bean farmers in Brazil are in miserable straits because the price has fallen by 50%. In US, they are in slightly miserable straits, but you have the Farm Bill that will boost them in bad times. And then you have minerals, all kinds of minerals. Copper prices falling, aluminium, steel. Oil prices falling may be good news for a majority of developing countries, but for the 40 exporters, they are also in bad straits. Besides the commodity price channel, you have the manufacturing channel. Manufacturing exports are falling in developing countries because the consumer is beginning to reduce its expenditure here. It's been only over the last 2 to 3 months, so it's only the beginning phase. But we've had reports from China of millions of workers thrown out of jobs. In fact, we had statistics from our friend from China during an IFG meeting last weekend that even as US manufacturing jobs have been lost over the last many years, so has Chinese manufacturing jobs. This may be a surprise. But I did visit Tianjin, which is the biggest industrial area just outside Beijing, at the invitation of the top international economists in China. In Tianjin University is the top industrial economist. So we went to visit the free trade zone in 3,500 factories. And I said, oh, this must be an export. It's going to be a jobs boom for Tianjin. He said, no, actually we've done research and found that more jobs have been lost in my industrial city than the gains that we got from the free trade zones. And I said, why? Because we have all these local industries in textiles and so on. We have lost jobs because of China's accession to WTO and the drastic fall in our tariff. We've lost millions of jobs. And we have gained jobs in the export zone for export-oriented industries. But in net terms, we have lost massive amounts of jobs. So this was a surprise to me because it's counterintuitive from what you read in the papers. Now, this was a time when the manufacturing exports of China were booming. So now if you have that also being lost, plus the loss of local industrial jobs, you have massive job losses in China in manufacturing. A story which the world does not know. And I think the trade unions of both countries have to look at the situation rather than see one another as competitors or enemies. This is when the workers of the world have to unite again. Then the IMF story, of course, you see the G20 statement boosting the IMF, giving it a second life, and Japan giving another $100 billion to the IMF. We lived through the Asian financial crisis and saw IMF debt policies which were double standards on the grounds that we cannot have moral hazard in the developing countries, so local banks have to close down. You know what happened in Indonesia? You closed down 3 bad banks. You didn't tell the other banks that their deposits are guaranteed. So everybody pulled their money out of good or bad banks, and the good banks collapsed as together the bad banks. And there was massive capital flight of local capital, of local people to Singapore and other places, and that was disaster for the banking industry in Indonesia. Contrast that to what the US did here, or the Europeans did, which is to guarantee all bank deposits, to identify the bad banks, and to boost their capital and withdraw their debt assets. Something that the IMF said you cannot do to the Asians, and therefore allowed or facilitated or catalyzed the collapse of the financial institutions in Asia. So nobody wants to go back to the IMF. IMF, of course, asks us to raise the interest rates, allow free flow of capital, and reduce government expenditure. The most pro-cyclical set of policies you can think of. Look at the G20 statement. They said we have to be pro-cyclical, we have to be anti-cyclical rather than pro-cyclical, but the IMF did the opposite. And as Mark has said, and he has looked at IMF's latest conditions for Ukraine, Hungary, I think which other country, Iceland. Iceland was asked to put its interest rates up by 6 percentage points in one day. Right? Ukraine was asked to reduce its government expenditure from -2% of GNP deficit to a balanced budget. Total opposite of what the EU and US are doing, and total opposite of what the G20 are saying. So there's a contradiction there. G20 is saying use Keynesian and monetary methods to save yourself from recession. Maybe they were addressing that only to the developed countries. But at the same time, let's boost the IMF. And it did not say that the IMF has to take on the same reflationary policies. So if you boost the IMF with the 250 that they're going to spend plus 100 from Japan, and these $350 billion loans to developing countries are toxic. These are toxic IMF loans because they have toxic conditions linked to them. We are going to spread toxicity throughout not only the developing countries but the countries in transition. So the G20 did not, I never saw the G20 saying that the IMF has to reform its conditionalities. It did not say that. So that's bad news. And finally, the G20 said that we all have to finish the Doha round this year, the modalities. What are the modalities? The modalities not only include the fact that developing countries have to open up their agricultural sector without a safeguard mechanism, which India is fighting for. If you're going to finish the modalities, you have to give up this safeguard mechanism. The US and EU will be able to continue their high agricultural subsidies, pretending to reduce them but not actually reduce them. And the developing world will have to open up their manufacturing sector by cutting their tariffs from an average of 30 to 50% to something like 8 to 10%. And open up their services sector, particularly financial services, including new financial services and instruments. That has not changed. Nobody withdrew their proposals. So what are we doing in the Doha round? We are spreading the toxic financial system that is being disbanded here, but exporting it to developing countries at the same time without saying, I'm so sorry we had these proposals to export our dysfunctional model, which we are now throwing out. It's saying, you take on our toxic model while we are dismantling it here. Not only the US, the EU also through its economic partnership agreements. That's why I have a paper there. We have looked at the completed EPA with CARIFORUM, the Caribbean countries. And it says free flow of funds, in other words, the total opening of the capital account, which the IMF actually gave up, but which is now coming in through the free trade agreements. Opening up of the financial services sector, a special chapter on that, and a provision on new financial instruments and services. That is, that we are able to export European hedge fund activities and so on to you, whether you like it or not. Okay? This was completed 1 month ago, this EPA. So I would like to say that the EPA of the EU is obsolete. The financial crisis and it made it obsolete. Even the EU will not be able to do. But you know, the problem is this, there is no Caribbean hedge fund that can then invade the EU and violate its space now. But the reverse is true. The hedge funds that may now be regulated in the EU may float to the Caribbean. And the EPA will be also concluded in Africa and in Pacific. And they are not doing new EPAs for Korea, for India, for Malaysia, for ASEAN. The US FTA is much worse than the EU one, because the EU at least does not have an expropriation clause that says that you can take up a case In the US, you have an expropriation clause. In other words, the loss of any future earnings and profits will have to be compensated by the developing country to the US financial institution. If you commit yourself and you did not meet up to the commitments, we don't care why you didn't meet up to your commitments. You may say, oh, we are following what you did in the US because you changed your law, so I'm changing here. They say, I'm sorry. Your bank can take up a case against mine if you can't enter my territory, but there's no bank that can enter US territory. But my bank can also take up a case against yours, and of course there are many American banks that are going to go. So if we regulate the hedge funds and the investment banks and so on here, and we don't regulate them in developing countries because we didn't tell them how to regulate or we don't permit them to regulate, then you're going to find a transfer of this kind of toxic behavior to developing countries, which they have to accept because they are under an FTA, and which if they don't accept, or which if they now renounce, they may have to pay for it. So these are all the horror stories. Now the proposals, I have 6 proposals, very fast. Real reform to the IMF. How? Let the IMF play its traditional role of being the tail that actually regulates the dog in the right way. It's not just a passive tail, but a tail that actually regulates the dog in a proper way. Re-regulate currencies so that they stabilize. If not a fixed exchange rate system, something near to that. Make it legitimate for countries to impose capital controls on capital flows that are not related to trade or production, which is what the IMF was set up to do. When we say that, they say, how can the IMF do this? That was the reason why the IMF was set up, to have capital controls. In other words, institute or legitimize through an international network or through laws a system of capital controls that will regulate finance to serve the needs of industry. The IMF can help to re-regulate the finance sector if it knew how to do it. I don't think it knows how to do it. The banks have to go back to playing its role as banks and not as facilitators of casinos or themselves being casinos. Leverage that the banks give to speculators have to be reduced. For example, instead of the hedge funds being given a leverage of 50:1, and then they spin the 50 into positions of 1,000, so that with $1 you can have positions of 1,000 and speculate around the world. The banks can tell the hedge funds, like everyone else, I'll look at your collateral and I'll lend you 1:1. If you have a house worth $200,000, they will give you a mortgage of $200,000. Do that to the hedge funds. The hedge funds will go out of business. Well, that's their problem. Second, since the IMF cannot reform the way I've just put forward, build the other alternatives and let the IMF shrink away as it was shrinking away. At least, if the US and the IMF is not going to help facilitate competitors, do not stop the competitors when they want to come up. Don't help them, but don't stop them. Whether it's a stabilization fund that South America is trying to put together, or the Asians are trying to upgrade their Chiang Mai initiative into an $80 billion stabilization fund. There are teething problems. We don't know how to do it. We have to try to overcome the teething problems of politics, cohesion, will, and most important of all, I put it to some of the policymakers, I know why you're not really building these funds. You don't know that if you put in your 10 billion, whether you will get it back, because you don't know whether the country like Pakistan you're lending to will use it properly. And if they don't use it properly, how do you get the money back anyway? Unless you're willing to give it as a gift. Very few people are willing to give away gifts of $10 billion, $500 million maybe. So we have to solve that problem. Loans come with conditions. Question is, what is the economic model behind that condition? The IMF one is wrong. Maybe I don't mind lending to Pakistan or to South Africa or Korea, if it comes to the conditions that you have to reflate, you have to reduce your interest rates, you have to have capital controls, you have to stabilize your exchange rates. The total opposite of what the IMF conditions are. and the conditions which Malaysia, which defied the IMF, took on in 1997 to 2000. The kind of conditions that I was talking about. We reduced the interest rate, we reflated government expenditure, we fixed the exchange rate so it was stabilized, we instituted capital controls, and the economy recovered in 1 year, 2 years, and became the alternative to the IMF. Now, I don't mind putting my money into that kind of condition rather than the IMF kind of condition, because my kind of condition is more likely to succeed, and then I will recover the money, than putting into an IMF condition where I won't recover the money. FTAs have to change. The investment chapters of FTAs are extremely toxic and will facilitate the spread of financial crisis to developing countries, but not the solutions to the financial crisis. So the US will have a financial crisis and solve it, the developing countries will not. The services and financial services chapters of the US FTAs are very toxic. The zero tariff for industrial and agricultural products for developing countries are very toxic because we don't have subsidies to back up when companies and farmers go bankrupt. The US has, so it's not a level playing field. The developing countries, if they go to zero tariff under the US FTAs, will not have the revenue base on which they can reflate their economies, let alone give subsidies to their banks. And the competition chapter in the US FTAs is laughable if you look at what is happening in the US now. Okay? A government cannot help a private company or a government agency when that company or agency is in trouble. For example, you look at that chapter and you laugh. But it's still there. Now the US can violate, but the developing country is not going to challenge because it's not made any loss. They did not go to US and lose. But the developing country, if it violates, because we start subsidizing, the US company in my developing country will complain and get compensation. Is a joke. The WTO has to change. Don't complete this Doha round because it is utterly flawed and will make the financial crisis worse. The pressures of developing countries to open up their financial services under plurilateral negotiations in the round has to stop. The US has to say, we are closing this negotiation, we are not putting pressure on you anymore. Because what we are pressurizing you to do is to take on a model that we are now rejecting. And we can't do that. Especially since my president's name is Obama, and he's a nice guy. So he can't do that, I'm withdrawing. That's what the US has to do. The US has an active proposal in the Rules Committee of WTO. If you look at it, it's worse than the FTA. You will laugh. You know what it says? 5 new proposals by the USTR 1 year ago. No WTO member shall have government providing loans to any institution, financial or otherwise, when those loans are not, when those institutions are not normally creditworthy. Okay? Another proposal, no government agency shall inject any equity into any private or government agency if that institution is not considered normally commercially equity friendly. In other words, if a normal private investor will not put it into a company because that is not it's not going to be sustainable from an equity point of view, the government should not do so. Those are only 2, there are another 3. You can laugh, because when the US put this forward, the developing countries like China, India, Brazil, and said, this is very bad because we have a different industrial model than yours. You may not subsidize. Yes, we understand the US doesn't subsidize, but we do. Today, the US is the biggest subsidizer. So China, Brazil, and India are having a big laugh, except the US has not withdrawn this proposal. Unbelievable, but true. 5th, we should have a commodity price stabilization emergency action. Never talked about in this G20 statement. This is the one that hits all the poorest developing countries because their only export is commodities. It also hits the middle income countries like Brazil or Malaysia. Back to the commodity problem again, commodity prices. Emergency action is the most important if we are going to not have this crisis affect the poor people in developing countries as contrasted to the industrial companies and so on. Finally, developing countries themselves have to get their act together. They have to respond nationally to the right macroeconomic policies like boosting spending, low interest rates, capital controls on outflows, capital controls later on inflows, standstill on debt payment, standstill on portfolio outflow, and repayment of debt according to market rates. Don't pay back 100%, pay back 20, 30, 40 cents, whatever the market says is worth. Developing countries should cooperate regionally so that they can lend each other money. They can stabilize commodity prices by taking action to reduce the output, for example, of palm oil, rubber, whatever it is, coffee. And they should get their act together in formulating what the new international system should look like and inputting that either through the G20 if that continues, and preferably through the United Nations, which is much more democratic. But if the G20 is a game in town, don't give it up. Those countries that are not in the G20 should pressurize the other developing countries in the G20 to also represent their view. And in the meanwhile, we should set up the alternative under what is multilateral, the UN or otherwise, that comes forward with a genuine solution. You see, the G20 did not represent many of these views, so it's flawed. Maybe we are too arrogant. Our view is not inside, so it's flawed. But I think my view is more representative of what will help the developing countries than what our own developing country G20 members managed to extract out of that summit. Anyway, that summit was only a beginning. We know the real one is going to be in April. That gives us time to prepare. That gives the Obama people time to prepare. That gives the developing country governments time to prepare. That gives us as civil society time to prepare. Our moment is here. Do we rise to the challenge and prepare and put forward what should be the new alternatives and somehow get it into the G20 summit, but otherwise into other processes as well? I think this is a challenge for us. And I thank CEPR for organizing this session today so that we can all discuss it. Thank you.